We've talked about over and over that ultimately the U.S. may need to revalue its gold, which is valued at $42 an ounce on the books, and that revaluing it higher would automatically create a deposit into the Treasury General account, free and clear for Besson to use for lots of different things, which is very useful for a country and for the United States in particular in increasing the acute fiscal and debt problems. And so revaluing gold, increasing a deposit into the TGA, you don't have to sell any gold to do it. It's just an accounting entry that creates dollars by using the gold instead of having an offsetting debt that you have to issue to get those dollars. This would be a way for the U.S. to get the price of gold a lot higher before revaluing the gold. Right? Ultimately, a 39% tariff on gold, price of gold should go up 39% in U.S. dollars. China's a bit of a special case in the way it is structured, which I mean, by which I mean you have state-owned banks, state-backed developers, state-backed debts. So that's two sides, right? That's creditor, debtor. State-backed banks are the creditor, state-backed debts are the debtor. If one defaults on the other, who takes the loss? They're both the state. Nobody does. It's like if a tree falls in the forest and no one hears it. Did it make a sound? However, as many rightfully point out, the currency would take the loss, right? All else equal, the currency takes loss. That's where China has sort of structured itself as a special case. They've been very smart about this. The Chinese, the PBOC and the CCP clearly seem to understand this because of how they've structured the system. You can see it by how they've done it. What do I mean? They've got capital controls, right? So the currency would take the loss in theory, but you have capital controls, so you can't have capital flow out. Currency isn't going to flee when that happens. Okay, well, that's not exactly true. They have very strict capital controls, but gold they do have an open capital account on a limited basis under certain conditions for foreign creditors around gold. And the Chinese government, as far back as 2002, with the PBOC, have been encouraging Chinese citizens to buy gold for almost 25 years now. The Shanghai Gold Exchange is a division of the PBOC. I didn't know that until, 6 months ago, but it's true.
Yet there's a carefully managed exception, gold. In a tightly controlled capital account, China permits limited foreign exposure through this precious metal. For over 2 decades, the People's Bank of China has encouraged domestic gold accumulation, a way to inoculate citizens against external shocks. Guess what? They even own the Shanghai Gold Exchange. Today, this system ensures that if economic strain hits, wealth remains inside China in the form of gold, increasing citizens' paper wealth when gold rises in RMB terms. It's private wealth accumulation tied to national resilience.
Think about it this way. In theory, state-backed bank, state-backed debtor defaults on the bank, both state-backed, no loss. There's no ability for currency to flow out except on a limited basis through gold, but you've already preloaded your citizens for 20 years with gold. So the only way to get capital in any real way out of China is for the price of gold to go up a lot in Chinese yuan. Well, what happens if gold goes up a lot in Chinese yuan? Well, the gold that all its citizens have been front running for 20 years goes up. Their balance sheet goes up in yuan terms. It's very elegant. You got to give it to them. It's very elegant, particularly when you then lay around something we have been talking about ad nauseum for years, which is this would still be a problem for the Chinese yuan relative to commodity prices and then relative to their dollar-based FX reserves if commodities could only be priced by the Chinese or bought by the Chinese in dollars. But they don't. This is why the yuan oil contract and the yuan commodity shift has been such a big deal, why we've been harping on it. Because now, if you had gold prices go up in Chinese yuan, as I just described for the reasons I just described, and oil and other commodities were only priced in dollars, then you're going to get basically commodity, high inflation, hyperinflation debt crisis in China. But with oil and other commodities priced on the margin in yuan, it doesn't have to be the majority, it just has to be on the margin. Now what that means is the price of gold goes up in commodities. Gold buys you more oil and copper and everything in China. And now it becomes a virtuous cycle for the Chinese consumer and standard of living vis-a-vis commodities while deflating their debt bubble. It's very, very elegant. You have to tip your cap. And it's a reason why I continue to say the Chinese have way more staying power than most naysayers have been saying for 20 years. Gold is a very powerful weapon, particularly when you're trying to compete against a reserve asset like long-term treasury bonds. Gold beats bonds. It's like, rock, paper, scissors. Like rock beats scissors every time, over time. So at any rate, some things to think about and chew on that front. Ultimately, I think it's one of the reasons I'm so bullish on gold, is the way the Chinese are so elegantly using it and reattaching it by virtue of this to commodities. You're basically net settling yuan commodity-related imbalances in gold. And so that means you basically have global commodities on the margin bidding gold. Oil market alone is still some 5, 10, 12 times bigger than the global gold market in annual physical dollar terms. And so guess what? Gold to oil ratio goes from 8 barrels an ounce in 2008. It's 53 today. 53 barrels an ounce, up 7x almost in 15 years.
This gold-centric system's brilliance shines when layered with China's shift in how commodities are priced. Until recently, the yuan couldn't touch global oil and raw materials. The dollar reigned supreme. Now, with yuan-denominated commodity and oil contracts gaining traction, China breaks the dollar's grip. So when gold appreciates in yuan, domestic investors' wealth rises, and they can translate that into more buying power over commodities. It sparks an elegant, virtuous cycle. Commodities priced in yuan empower consumers, elevate living standards, and help deflate systemic debt pressures.
When you talk about the passive base, talking about just the mindless sort of weekly, bi-weekly paychecks diverted into 401ks, etc. Problem is that it would also tank U.S. tax receipts very quickly, both from the employment side and from the stock market side. And since as we sit here today with receipts at all-time highs, with stocks at near all-time highs, with home prices at near all-time highs, with employment still very good, U.S. true interest expense today is over 100% of all those all-time high receipts. Despite all that, the reality is if you had a rollover in employment and a rollover in stocks, the U.S. true interest expense would quickly be well above receipts. In other words, interest, entitlements, Veterans Affairs. Putting the U.S. into a position where they have to choose. Cut Veterans Affairs, cut entitlements immediately, cut interest rates, print money, or default. Default ain't never going to happen. And politically, we would have a revolution by the weekend if you cut entitlements or you cut Veterans Affairs. Guess what they're going to cut? What are they advocating for? Powell cutting rates aggressively? Why do you think that is? This is why this is. They're already over 100% of true interest expense. They need to. They have to. It's the only thing they can cut. And so ultimately, that's what they're going to cut, one way or another. However that is chosen to be structured, there's a number of different ways they can do it. But in my opinion, for the average investor, I'm not talking about the pro who has a monthly mandate or a quarterly mandate, but for the average investor, it really boils investing down to simply keeping oneself more liquid than the U.S. government. All you have to do is survive longer than it takes for the U.S. government, the U.S. Treasury bond market to dysfunction in a market sell-off or a slowdown in the economy. Because essentially, the only way you lose at that point is if the government stands aside and says, you know what? Either we're going to cut entitlements and Veterans Affairs aggressively, not interest expense. Come on, that ain't going to happen.
China's strategy bolsters long-term resilience, notably in comparison to Western financial models. Gold, as a non-yielding asset, may outperform long-dated U.S. Treasury bonds, especially as bonds face rising interest burdens. Against that backdrop, China's system, by anchoring wealth in gold and redirecting commodity exposure, presents a potent alternative to conventional reserve asset paradigms. It makes gold a strategic weapon in global finance. This may explain why China continues to extend its grip. Patiently built gold reserves, currency control, and new yuan-based markets are slowly undermining the dominance of dollar-denominated instruments.
Or they're going to stand aside and say, you know what, we're just not going to pay the interest on the bonds this quarter. We're going to default. Come on, that ain't going to happen. So they're going to do something quickly. So it's about managing that timing for the average investor, in my opinion, until they come in and re-inject dollar liquidity to keep the Treasury market from dysfunctioning yet again, which it has done 5 or 6 times since 2019. And when I say dysfunction, the easiest definition, you're going to have a spike in Treasury volatility, you're going to have a spike in rates into a slowdown. We saw it in Liberation Day. Remember that? Hey, everyone looking around going, hey, the dollar's going down, rates are going up, stocks are going down. What's happening here? If you like that, you would love what would happen if they decided to stand aside, which is why they won't, and which is why they didn't post-Liberation Day. It took them 6 or 7 days. In my opinion, there's a variety of possibilities. I don't have strong conviction on either or any of them, but let me lay them out. Either he didn't know any better, and so he decided this was a good idea without sort of knowing all the details, and then backtracked once he learned that it might not be a good idea. I think the second possibility is he did it knowing some of the details, knowing what the reaction would be, which would be gold going up quite a bit, quite potentially. And someone that we'll call Kaiser Soze, in reference to the great movie The Usual Suspects, essentially told him and his administration that no, you cannot do that in no uncertain terms. And I'm not saying by any sort of threat or anything, I'm just simply saying.
Meanwhile, the U.S. faces mounting fiscal strain. True interest costs covering debt service, entitlement programs, and veterans benefits currently exceed entire federal revenue streams. Throw in potential downturns in employment, housing, or equities, and the imbalance would quickly spiral. Politically, sweeping cuts to entitlements or veterans programs are all but impossible, and outright default is unthinkable. Thus, U.S. policymakers must choose between aggressive rate cuts, massive monetary injections, or creative accounting shifts. One such idea, revalue the United States gold holdings, currently recorded at $42 per ounce, upwards to inject liquidity into the Treasury's general account without selling assets.
There are still rules, and there are rules that even he is subject to. And the Kaiser Soze would be the managers of those rules. And we can have a debate or discussion around whether those are high-level global finance people, Bank of International Settlement. Who knows? But that's the second option, is Kaiser Soze told him, no, you can't do that. The third option is that he did it and then reversed course simply to try it out. See what the reaction is. See what the market reaction is. Offer some market participants a chance to get on sides if they were short gold, to introduce this as a potential possibility. Because ultimately, we've talked about over and over that ultimately the U.S. may need to revalue its gold, which is valued at $42 an ounce on the books. And that revaluing it higher would automatically create a deposit into the Treasury General account, free and clear for Besson to use for lots of different things, which is very useful for our country and for the United States in particular in increasing the acute fiscal and debt problems. And so revaluing gold, increasing a deposit into the TGA, you don't have to sell any gold to do it. It's just an accounting entry that creates dollars by using the gold instead of having an offsetting debt that you have to issue to get those dollars. This would be a way for the U.S. to get the price of gold a lot higher before revaluing the gold. Right? Ultimately, a 39% tariff on gold, price of gold should go up 39% in U.S. dollars.
We're watching a silent competition. China's carefully crafted financial framework with gold at its core, yuan-denominated commodity pricing, and capital barriers versus U.S. fiscal and monetary challenges. Will Washington lean on gold revaluation to ease pressure or default into instability? Will Beijing extend its yuan's reach into global markets, undermining dollar hegemony? For the everyday investor, the takeaway is clear. In an era defined by fiscal stress and monetary innovation, liquidity and adaptability may be your strongest asset. Stay alert, stay flexible, and keep watching this evolving financial battleground.
And if they do that, then, call it $4,700 gold versus $3,400 today, you'd be putting like $1.5 trillion almost, $1.2 trillion, $1.3 trillion, I guess, $1.2 trillion into the TGA. Besson could then go, hey, I got $1.2 trillion sitting here. I don't have to issue any long-term debt for the next 2 years at all. And so then they could cut rates, and while everybody thinks that rates are going to take off when the Fed cuts rates, when the Fed cuts rates, what if the Fed cut rates 50, 100, 200 basis points And Bessent goes, we're going to revalue the gold. We're not going to issue any long-term bonds for the next 2 years. Guess what's going to happen to long-term yields? They're not going up. I don't think they're going to go up much at all. They're going to go flat to down. And so I don't know which of these options it is. I don't know if he just didn't know better and had to backtrack. I don't know if Kaiser Soze told him to backtrack and he did. Or if this was just a test of the emergency gold revaluation system for those of us that are old enough to remember watching TV and getting those things periodically on TV on Saturday mornings or what have you. So, as I like to say, let's watch.